There is a lot of information online about the infinite banking concept, some good and some bad. There's so much information that it sometimes makes the infinite banking seem complicated, but really the concept is very simple.
Infinite Banking Made Simple Binder is a free resource on our website. In this episode, we're going to be talking about information in the binder, so go to mcpheeinsurance.com and click to open and follow along.
There are two ideas behind infinite banking. One is the basic idea, and that is being able to use your money while it's still growing and compounding for you. The second idea is the big idea. And the big idea is really something that if you grasp, you get the whole thing altogether. When I was a chiropractor, B.J. Palmer, the developer of chiropractic, said, if you get the big idea, everything else will follow. And the same thing is true in infinite banking. If you get the big idea, you're going to get the whole shebang.
And the big idea is that you recover the money you're spending.
In order to be a bank, you have to have depositors.
With infinite banking, the life insurance companies become the depositors in our banking system.
Banks never lend their own money. They have to have equity someplace stored so that they can have other depositors come in so they can lend that money out. In infinite banking, the life insurance becomes your depositor. And in order for them to loan you money, you must have equity with them.
When you said the word equity, we often think about equity with a home. So when you purchase a home, with every payment you make, you build equity in that house. And when we're talking about equity and life insurance, it's very similar to equity in a home.
You go to get a policy loan from a life insurance company, what's your equity with them? Well, in order to have equity with the life insurance company, you're going to have to pay some premiums that build equity. Now, not all premiums that you pay to a life insurance company build equity. You pay premiums for a term life insurance policy, there's no equity. You pay premiums for some types of permanent life insurance, and there is very little equity that builds. But when a policy is designed well, you pay premiums to the life insurance company, it can build a lot of equity.
The equity in a life insurance policy is what we call paid up insurance. Very similar to a mortgage. Every time you make a payment on your mortgage or a car payment, you build a little bit more equity in your car or in your home. When you buy whole life insurance, every time you make a payment, part of your premium pays off a little bit of your death benefit, and that little bit of death benefit that's paid up is called paid up insurance, and it develops equity. The equity in whole life insurance is called cash value. And once you have cash value, you can leverage that cash value with the insurance company or with some banks even, and they will loan you money dollar for dollar, and then you pay interest to whoever you borrowed the money from.
It's like having a fully collateralized loan. So if you have $100,000 of cash value at the life insurance company, you can go in, they're going to take a look and they're saying, okay, what's going to be the interest for the first year? And there might be a little bit of cash value that's needed to keep the policy alive. They'll give you a policy loan for the rest of that. So very close to $100,000 minus the interest for the first year.
In fact, you can borrow more on the equity of a life insurance policy than you can on the home equity of your home.
True.
The home equity in your home. Because most banks will loan you about 80% the value of what your equity is in your house, unless you're going to pay a premium to them to get the insurance to cover the other 20%. Whereas in life insurance, it's usually between 90 and 95% of the cash value equity that you can borrow against.
And the nice thing about getting a policy loan is you don't have to be underwritten for that loan. So if you go to a bank to get a home equity line of credit, then you have to qualify for that loan. You have to prove that you can make payments, that your income is sufficient for it. And they have to oftentimes approve what you want that home equity line of credit for. When you go to take a loan from your life insurance policy, you don't have to qualify because when you purchased the policy, you were underwritten, your life was underwritten for the policy. And now you don't have to show any underwriting for a loan that you request. So you can take a loan for a vacation. You can take a loan to buy business equipment. You can take a loan to pay off debt. It doesn't matter. You've already been underwritten.
And you don't have to even say why you want the loan or prove that you can pay it back.
Yes. In fact, we've had people who have lost their job and they need money to help them through a rocky time when they don't have income. And they can take that loan and they can decide on a payment plan later. They don't even have to have a payment plan to start the loan.
That is a beautiful flexibility that's built into the infinite banking concept. Because it's a system that you control, you can take a loan even when you don't have the cash flow at the present time to pay it back. Now, the big idea of the infinite banking concept is to recover the money that you're spending on a regular basis. So you do want to pay those policy loans back. It's not something you want to take a policy loan and say, hey, I don't have to pay this back, so I'm not going to. Well, you're going to kill the best business in the world.
When I think of the big idea, I think about a guy coming up to a flagger that has a stop sign. And he comes along, he can see a lot of construction equipment up ahead, and he stops, maybe puts down the window and says, hey, what's the big idea? Well, the flagger doesn't say, we've got a stop sign here. We don't want you to hit anybody. No, he's asking, what's the big idea? What's happening here? Why are they tearing up the road? What are they doing? And when we've got the big idea, it's more than just having a stop sign. It's more than just having a policy. We've got a big idea of something that's happening up ahead that may not affect you too much today as you're driving along, but it's going to affect you overall because this road project is going to make travel easier in the future. And same thing with a life insurance policy. The big idea is going to help make your future better, make your retirement better.
Now, when people have first started a policy, they've taken a policy loan and they've paid it back. Maybe they haven't recovered all the money that they spent on that purchase yet, because it's going to take a few years to do that. You know, the road construction project isn't completed overnight. But the basic idea of the infinite banking concept, you get started with that right away, because the basic idea of the infinite banking is that you're starting a life insurance policy so that your money can continue growing while you're using it. That's something that's very hard to do with any other tool in the financial world.
Well, that basic idea tells us to start funding a life insurance policy, let the cash value grow, leverage that cash value, and then create a repayment plan. And that repayment plan is what moves us into that bigger idea.
There are some key differences between the infinite banking concept and what you typically see in the banking world. When you take a policy loan, you don't have to go through any credit checks because it's a fully collateralized loan. With the policy, you get tax benefits with the growth in that policy over time, and you also get control and liquidity with your money that you get to manage. You also get growth on your money while you keep using the money, which accomplishes the basic idea of the infinite banking concept. When we get back from the break, we're going to go through some examples of paying off debt, making an investment, and buying a car with the infinite banking concept.
This is the Infinite Banking Made Simple binder. Everything you need to know about infinite banking in one spot, and it's a free download. Answers to the top commonly asked questions like what is infinite banking, how does it work, and how much does it cost to get started are answered right here. You'll find the step-by-step diagram starting on page 7 and the investment comparison on page 8. This Infinite Banking Made Simple binder is a free download. You can click the button to get your copy. At McPhee Insurance, we believe infinite banking has become too complicated and confusing, but it shouldn't be. And that's why we created this binder. Infinite banking is simple when you stick to the essentials and the facts, and the people who put it into practice get results. Don't let insurance terms like modified endowment contract, 7-pay test, direct recognition, and paid-up additions keep you from understanding infinite banking. Download the free binder and see how infinite banking can work for you.
So if you open your binder to the page where it says debt payoff, we're going to go over that example right now. And in this example, we see that Someone owes $11,000 on a credit card, and that credit card is charging them 24% interest, and the minimum payment is $330 a month. At that rate, it's going to take them 56 months to pay off that credit card, and they'll pay back the $11,000 debt, plus they're going to pay $7,308.40 worth of interest to the credit card company. Total, that means they've paid $18,308.40 for something they purchased that only cost $11,000.
And at the end of that 56 months, that 4 years and 8 months, they will be out of debt. That's it.
So let's now look at what would happen if this person was involved with infinite banking and had been able to build equity of $11,000 in their infinite banking whole life policy. They could have simply asked the insurance company for $11,000 loan, paid off the credit card, and then made that $330 payment to the insurance company for the next 56 months. In the end, they would walk away with $20,300.40 because the principal would have come back to them, so they could use it again. The interest that they paid on the loan would come back to them, and they could use it again. The growth of the policy of $2,884 would come to them, and they could use that. And part of what they have to pay is $892 that the insurance company would have kept, and that's the interest that the insurance company gathered on giving them that loan. So they walk away with $20,300.40 plus whatever they purchased, which is a whole lot better than just being at zero.
They walked away with more money than what they paid on the credit card, even though the credit card was at a much higher rate of interest. Now, they still made those same payments back to their infinite banking system, but they get more benefit from it. There's an important prerequisite, though, that they had to have in place. They had to have this policy already started in order to use the benefit like this.
And I remember when we were first starting into the banking concept, I couldn't really grasp why that would be better than just saving up my money and paying cash for everything, because that's what I'd been taught to do, and that's what we did. We paid a house off with cash. We bought our cars with cash. I paid my college education with cash. It was like it was really hard for me to grasp the difference here. And we can accomplish sometimes the basic idea without a life insurance policy, because we can save our money and use it as collateral in a savings account, let a bank loan us the money, and we can walk away with a little bit of difference in interest between what we paid and what we earned. But in the infinite banking concept, we get our money back. That's the big idea. And if we grasp that big idea, the basic idea just automatically comes along with it.
Now let's look at the next page in your Infinite Banking Made Simple binder that talks about making an investment. If you take a $300,000 from your personal banking system and you make an investment that's going to grow at 20% interest for 5 years, that's 20% annual percentage rate, then the growth on that investment is going to be about $446,000. So you're going to end up with $746,000 in the investment when you consider the $300,000 that you put into it. You don't just end up with that because the policy has continued growing during this time. So you have about another $90,000 of growth from the life insurance policy. You end up with over $847,000 of total growth. But what if instead of gaining 20% every year, your investment actually loses 4% every year? Well, in that case, the $300,000 that you put into this investment, it loses 4% a year. You're going to lose about $55,000. You're only going to end up with $244,000 in this investment. But the beautiful thing is you still get the growth from the life insurance policy, that $90,000 plus. So you're still in the black by a little bit, even though your investment actually lost money. It acted like a buffer for you. You had a guaranteed foundation to fall back to.
This example reminds me of what Nelson Nash writes about in his book, and also what he also talked about at his seminars. I remember him saying, okay, you think you can get a higher rate of return in an investment than I can? You make your investment, and I will make the identical investment after I've borrowed for my life insurance, and we'll compare notes afterwards. And of course, Nelson was so confident in saying that because he knew he had dividends working for him. He knew he had the guaranteed growth of the policy working for him. He knew he had a death benefit this entire time. And he knew that even if there was a loss, just like in this example, he could come out ahead of the person that was making the identical investment that he was.
And now let's look at a car purchase. You could take $20,000 and go to the car dealership and purchase a car. The problem is that when you pay your $20,000, you no longer earn the growth on that $20,000. If you had earned just 3% over the next 5 years, you would have earned $3,185. And now that is a loss to you. With the infinite banking system, you can borrow $20,000 from your policy and make that same car purchase. Over the next 5 years, you will have growth in your policy, just guaranteed growth. There's no rate of return on that. It's just the guaranteed growth, what you were guaranteed from the beginning. And you could also earn dividends during that time. And in 5 years, the growth would have been $6,458. Plus you have the car. You have earned on your money and you have the car. Now, for even better results, you should be making payments back to the policy to repay that $20,000 so you have it to use again. But again, this example was with no repayments. You paid cash from your stash and lost growth on that, or you paid cash from a loan from your insurance policy and you continue to have growth. Make those loan repayments and you'll be able to use that money over again.
And what I like about this example is it shows that the interest that you paid for that policy loan is only $2,450 over 5 years. And if you'd have paid cash for it, you would have lost $3,185. So it's just a no-brainer when you look at the cost difference between these two loans. You either give up $3,185 or you pay $2,450 and walk away with $4,008.
And this example is limited to 5 years. In reality, the guy who did not use the infinite banking method, that $3,100 that he lost doesn't stop at 5 years. It keeps going. What could he have earned after 6 years? What could he have earned after 7 years? That never stops.
And you know, that right there, John, is why I literally cringed when I learned about the infinite banking concept, because I had written a check for cash for our second home.
Oh.
And I started adding up all the interest that I had thrown away up until the time. And I'm still throwing away that money because I never recovered that money that we paid for that house. I mean, yeah, we sold the house and got the money, a little bit more money out of it, but not near what we could have on the compound growth of the money we paid for that house in cash.
And we got great benefit from living in that house for several years as well. So yeah, you can't stumble over lost opportunity all the time, because if we always thought about lost opportunity, it's living life in the rearview mirror. We can't do that all the time. At some point, you've got to cut it and say, okay, from this point forward, I'm going to do things differently. But yeah, lost opportunity is one of those things we can use to help measure an opportunity, but it doesn't stop just at 5 years. We do have to keep that in mind when we're looking at the numbers.
I remember Nelson telling a story about sitting around the table with a couple of guys that he had known for years, and they were talking about lost opportunity, and one was moaning about this lost opportunity and that opportunity. And Nelson said to one of the fellows, if you were really concerned about lost opportunity, you wouldn't put that bite in your mouth, because you just lost the opportunity on the cost of that meal.
Right.
You got to live.
Yeah.
And we live to the best of our ability. And you know, the old proverb that says the teacher will appear when the student is ready. That was certainly the case with us. We were ready for the infinite banking concept because we had gone the cash route, like so many people teach, that's going to save you money and not pay interest, and you're going to get wealthy by doing all this. And that's just not true.
One of the beautiful things about the infinite banking concept is we don't have fees and penalties to access our money. So many people, they're precluded from doing the infinite banking concept because they put money into a 401k or their IRA, and that is their life savings. They can't access it to use for things that they're buying throughout the rest of their life. So they have a big purchase come up, they've got to go to the bank and get a loan. Or they have to save more money outside of those tax qualified plans. They have to start saving even more to be able to pay cash for something. They have limited their options when they've gone that route.
And oftentimes those limiting options, the things that are costing them right up front, negates some of the growth that they're getting in the 401k
Yes.
or the IRA because they're paying so much up front.
Yeah, think about the number of people that contribute to a 401k but then carry credit card debt
Oh,
as well.
yes.
Or they're paying the high percentage on a margin loan. Why are you doing that?
That reminds me of the man who called in one day and said, I've got all these properties. I've purchased them on a credit card. Here's my cash flow on the properties. And he's so excited because he's doing real estate investing. Problem was, he had negative cash flow. The credit card payments were costing him more than the properties were generating. And he didn't understand the math on that. He thought he was getting ahead because he's doing real estate.
So one question a lot of people ask when they come into the infinite banking, they want to know what interest rate the whole life insurance policy is generating.
Yes. What is it growing at every year? It's an investment mindset they're bringing into it.
It is. Nelson used to say, we don't come to the right conclusions because of the way we think. If we think like everybody else, we're going to come to the same conclusion everybody else has had. Infinite banking requires us to think differently about what's happening in our financial world. And whole life insurance does not guarantee an interest rate, because when you pay your first premium, even though the compounding internal rate of return might be 2% over the lifetime of that policy, there is not a 2% growth from year to year.
The reason is, let's say that they used a 2% rate in figuring the math for the life insurance policy. So they assume we're going to collect these premiums. The premiums are going to earn 2%. Then we're going to take out mortality and expenses. Now, those are two fancy words for what are we going to have to pay out in death benefits across all the policies that we've sold. We got to factor that into each policy. What's the mortality? And then the expenses are simply the expenses of running the life insurance company, which are going to include commissions they pay to the life insurance agents, payroll that they pay to their staff to service the policies. Those are going to have to be figured into across the board on all the policies that they sell. So when the insurance company gives us an illustration to look at, and we're looking at the guaranteed values, those guaranteed values are after those expenses have been taken out, which is a beautiful thing because now we see a number. This is what we actually get.
And the nice thing about that guarantee is even if that insurance company that issued that policy becomes insolvent for some reason, the insurance commissioners of every 50 states and the provinces of, Guam and Puerto Rico, all the things that, the United States governs, they will force the insurance company to either sell that policy to a company that will honor those guarantees, or the guarantee fund of that state or territory will cover the expenses up to $300,000, which is greater than the FDIC does on a bank account. That number is guaranteed. It's not an interest rate they're promising to pay you. It's an interest rate they're using based on their profits and what their expenses are. Like you said, the light bill, the payroll, the commissions, the mortality rates, all the things it takes to run an insurance company are taken out of that 2%, and they still guarantee this number back to the policyholder.
Yes. Now, it is possible to figure a rate of return backwards. We can say, okay, here's the number that we ended up with and the guaranteed cash value, or we could figure it on the projected cash value that includes the share in the company profits if they're paying dividends. And we say, okay, what did we pay in premiums to get to this point? What would be the rate of return that we would have had to earn on that to get to that number? That's called an internal rate of return. And sometimes when people look at the internal rate of return, they'll say, well, that's not very high. I could get a higher rate of return in this investment over here. But on the investment, remember, you're going to have to pay taxes and fees on that. So your actual rate of return, your internal rate of return on an investment is also going to be lower than the annual rate of return that you think you're getting.
Something that's often overlooked too is that if you don't have an insurance policy that you're saving money up and building cash value in, then you're going to either have to buy on credit or you're going to have to save up money in the first place. And so it doesn't make sense to say that you can get a higher rate of return because you're excluding some things and not including others.
Yes.
And so one of the big things that people are missing in that point is they're missing that you are buying a death benefit. Now, wherever do you get to purchase something and use the money you purchased it with for something else?
Yes. So if you say, oh, the life insurance policy isn't a high rate of return, you throw that away, you are choosing the investment return. If you say, okay, the life insurance policy isn't the highest rate of return, I'm going to use my money. I'm also going to make it an investment. Now you get some of the best of both worlds combined. And that's something that's very hard to do with any other financial tool.
So if we return to the construction site that we were at earlier today, and the guy yells out the window, "Hey, what's the big idea?" It's more than just the construction cones that we see. It's more than the gravel we're driving on. It's more than the flagger, because we can use infinite banking for lots of different things. We've given 3 examples today of credit card payment, an investment, a car. But what if you purchase a boat or a house or a business or business equipment, fund education? You're doing all kinds of things along the way in preparing for your retirement. And this construction project just got way bigger than you realized as you pulled up at the flagger. And years down the road, it's going to be a beautiful project, but along the way, it's a little bit gravelly, and you have to navigate the course and make all your decisions, because that's what life is like. And it's nice that we can see these examples, look at the math, and so we can make a good prediction that we are on the right path. Even though it's a little bumpy, even though there's some orange construction cones, we're getting to where we want to go.
When people are looking at starting the infinite banking concept, where's typically a good place for them to start? You talk with a lot of people. What do you typically guide them toward?
Well, the first thing we have to look at is what are they generating? What is their income? What are they producing? And then we have to look at where their expenses are. Because if they're spending more than they're making, we got to start even before infinite banking to get them in a track where they can start infinite banking. But once we get them to a point where they can actually turn their debt into an asset, and that is like the first example we did with that credit card debt today, is we turned that credit card debt into an asset that produced $20,000 for them instead of going in a hole of $18,000. So now we say, okay, what is comfortable and affordable for you to pay? And we suggest 10% of someone's income, because that is like a standard that's been around for over a century that says if you save 10%, you're going to be able to get ahead in life over people that don't. And that's a beginning point. And from there, we can design a policy. And, within 30 to 40 days, usually someone's got a policy and they're able to borrow from it quite rapidly to help them either make a major purchase or a minor purchase, or maybe to finance something like an investment, or even to pay off debt.
Well, in the binder too, we note that the average American typically spends $300 to $2,500 a month for a policy. And that's not to say that's the only range, because we've sold policies for less than $300 a month and for more than $2,500 a month. Also, people can pay annually. So it really depends. We are designing these policies for the individual so that they can be successful with infinite banking.
So we've talked about the basic idea of infinite banking, which is just earning money on money you're spending. And the second idea, the big idea, is being able to recover the cost of things that you purchase when you use infinite banking.
Mark Twain said the key to getting ahead is getting started. The same is true with infinite banking. To get started, contact us. We can guide you through the process of getting started with infinite banking and helping you be successful with infinite banking.
One of the beautiful things about the infinite banking concept is that you get to use your money during your lifetime in a responsible way that also allows you to prepare for the future by building an asset you can use in your golden years and as a legacy for your family.
Come back next week, where we're going to be sharing some infinite banking stories of clients of McPhee Insurance right here on Wealth Talks.